Welcome to this Fund Manager Q&A brought to you by Livewire Markets. My name is Vishal Texanani, and today I have the pleasure of being joined by Ned Bell of Bell Asset Management, and we're going to chat what's happening in global equities. We're going to talk about tech stocks. We're also going to talk about where there's value in the international equities market. Ned, thank you so much for joining me today. How are you?
Very well, thank you. Thanks for having me.
No worries. Ned, I want to kick off with something you said recently, and that was that earnings expectations in global markets are pricing in a seamless return to normality in 2021 with a relatively few bumps along the way. So, framing it that way, are you bullish or bearish on markets right now?
So I think, it's a really good question, and thanks again for having me. But when we think about the markets looking forward, we're very bullish about certain aspects of the market, but we also have some concerns about certain pockets within the market. So I think if I was to frame the way we're thinking, our concern is more around the achievability of earnings expectations for next year. So consensus estimates for the MSCI World Index are implying that earnings next year will grow by 28% on this year, which would also imply that they will be 12% higher than 2019. And frankly, we struggle with the achievability of that number. That implies very much a seamless recovery. And we still feel as though, obviously, COVID as a driver of economic growth is still in the background and really hasn't been completely controlled. So we still feel like there's some risk there. But I think if I was to break down the market into two buckets, probably the biggest risks are in what we would call the overvalued growth stocks, and also the more economically sensitive value stocks. So that's where we see probably more risk. From an opportunistic perspective, we'd probably say that the defensive quality names, they still look quite compelling. They have lagged, and valuation is pretty compelling, as are the small mid-cap names, which have also lagged.
That's great, Ned. So I want to get into those two pockets in a second, but just tell me about your portfolio positioning against that view at a high level.
Sure. So at a really high level, we are overweight that small mid-cap space. So we've got about 37% of the portfolio exposed to small mid-cap stocks. So it is pretty meaningful, and that is where we've been finding more and more ideas. At the mega cap end, we're quite underweight. We're about 7% underweight those top 10 stocks in the index. And then if you break down regionally, we're quite underweight in Asia Pac, a little bit underweight in North America, but our biggest overweight is actually in Europe. And that's where we tend to be finding really good relative value. And I guess from a sector perspective, it's probably the most notable divergences would be our overweight in healthcare and consumer staples, and our underweight in financials and industrials.
So let's come to those opportunities in a second. I really want to touch on something that really interested me in one of your recent reports. You said of the overvaluation in tech stocks, the current market frenzy is somewhat akin to the speculative investor behavior of the late 90s that's culminated into the dot-com boom and bust. Give me some color around why you're so worried about tech stocks. And if we can frame it this way, isn't it fair to say that it's different this time around? These companies are generating enormous amounts of cash. They've got immense intellectual property. They've got employees, plants. COVID has pulled forward demand at such a phenomenal rate. So isn't it the case that they're the premium high-end companies and they deserve these valuations?
Yeah, it's a good point, and I think you're quite right in making the point that the quality or the earnings power underlying these, particularly the big FANG stocks, it is very strong, and it's much stronger than what it was in the late 90s. But it's more around the idea of the actual investor behaviour. And I actually started my career. I was working in San Francisco in 99, 2000. So I was at the coalface. So I saw the final hurrah of the dot-com boom and bust. And there were some similarities in investor behaviour between what I saw then and what I'm seeing now. And I think when you think about the tech stocks as a whole, as much as there are some really strong companies who are generating huge returns on capital, there are also a lot of others that are not particularly profitable, and the management teams are prioritising growth over profitability. And then from an investor perspective, I guess valuation has almost gone out the window. It's almost been an irrelevance of late, and companies are being rewarded for, again, prioritizing growth over profitability, and it's really fueled this, I guess, this speculative frenzy where, many investors, particularly in the US, they are buying themes, not businesses, and that is pushing stocks to what I would call probably nosebleed levels. And another obvious example has been Tesla, which has been, it's an incredibly large company, but Elon Musk openly says that they are prioritizing growth over profitability. And I think, the way I think about it is that these extremities or extreme conditions often have a habit of mean reverting, and when they do, they come back with a thud. And so that's really some of the, and the other point or little anecdote I'd point out was that back in 2000, when I was working in San Francisco, I distinctly remember a lot of market pundits claiming that Warren Buffett was too old to understand the tech sector. Fast forward 20 years on, and last reports he was buying gold, and so I think so Warren Buffett's definitely outlived some of his critics 20 years ago, and there are some familiar tunes ringing now.
So I love the war story that you have. Does it feel like San Francisco again today? Are we at the last hurrah?
I think parts of as you pointed out earlier on, like COVID has brought forward a lot of the thematics and secular themes we've been talking about, and these companies brought them forward. So the immediate earnings power is very strong. But I do feel like we're getting to the underpinning economically behind the market is still pretty fragile. And I think that's probably what gives me the most concern. And I just think that we're approaching a point where the most speculative and the most expensive ends of technology and the growth stocks are just looking more and more vulnerable. And that's where we'd be a bit more concerned. And the other thing that's changed this time around, hasn't been in the past, is the amount of ETF buying and passive buying in these stocks, which has been absolutely enormous. And frankly, I just question who's the incremental buyer of those names when they come off.
Okay. I'd really like to, what I find fascinating here is you're saying this, but then how do you reconcile within your portfolio, your technology holdings? Because I believe you have 22% in tech, and Facebook, Google, and Microsoft make up some of your top 10. Yep. Is it a case that these are the safe havens within an overvalued sector? Help explain that to investors.
Yeah, sure. That's a good question. And that's the thing. We're not suggesting that you shouldn't have exposure to tech. We just think you need to be selective, and you need to focus on the companies that have got really good balance sheets, earnings underpinnings, and the valuations are sensible. So if you look at, like Google, Microsoft, and Facebook, we think those companies are fantastic with a lot of conviction in them. I think, and when we look forward, we still see good upside. That's the most important thing. We still see, on average, about 30% upside in those three names looking out over the next few years. They trade on an average PE of about 28 times this year's earnings. And from a growth perspective, we would expect them to grow their earnings in the sort of 17 to 20% range. So that's pretty good value for money. And if those stocks can literally just hold those multiples, which we think are relatively fair given the quality of the businesses, the earnings compounding alone is still going to deliver investors pretty good returns looking forward. So that's why we've got pretty big positions in those names. And also the balance sheets are incredibly strong. So when you strip the cash out, or if you were to strip the cash out of the balance sheets, the actual earnings multiples are even lower than that, and the valuation's even more compelling. So we're not going to sit here and say they're dirt cheap, but we are going to sit here and say, using a base case scenario of these stocks holding their multiples, the earnings compounding is going to be pretty powerful.
So it's not the case of buying no tech, it's buy high quality, well-capitalized tech.
Exactly right. And really discriminating between what I'd probably call expensive thematic tech and well-priced, robust, fundamental tech.
Okay, so I got to ask then, what parts of the tech market don't you like? And feel free to say, buy now, pay later.
Buy now, pay later. So I think within the global equity universe, it tends to be it's the stocks that are trading, 50 plus times earnings and have got relatively low returns on capital. They might be very, very quickly growing companies with great thematics, but they're so over-owned that they are a bit more vulnerable to earnings downgrade, so to multiple compression. So that's where we're probably steering clear from. And there's a lot more. Like I said, there's a lot more thematic stocks have dominated the market in more recent times, and we're just steering well clear of those, and really just trying to drill down on the businesses themselves and look at it from the perspective of we want to be owning, really high return on capital businesses that are going to continue to grow, and that sort of steers us in the direction of those names we talked about earlier.
So one of the things that I felt was unique about you as a manager when I was doing my research was your ability to invest in global small and mid caps. Most other fundies will invest in mega caps. That's what they stick to. Why this part of the market? What's the opportunity in global SMIDs?
Yeah, it's a really good question. So you're right. I mean, as an all cap manager, we can invest across the board, but we have added a lot of our alpha over the years in the small mid cap space. And we find that there's generally not nearly as much crowding in this space, but there's a very rich universe of companies that we think are very high quality from a fundamental perspective, but really importantly, they're not that expensive. They seem to have fallen between the cracks somewhat. And to some degree, I would suggest that's a function of the fact that institutional investors don't make big fundamental allocations to this space, and there's not a lot of ETF buying. So we do, and I should just highlight how we define small and mids, because it's a little bit different, but we take like MSCI, they use the bottom 28% of the MSCI World Index. So we take that approach, and that leads us to a range of about 1 to 30 billion market cap. Again, so that's a pretty rich universe of companies in there, and many of which they are growing very nicely, and they can complement large cap stocks really well. So we think it's a fantastic part of the market that most investors don't have that much exposure to. There are some very high quality businesses in there whose earnings are very much a function of their franchise, and a lot of them are generally not as cyclical as many investors would think.
So what I'm really curious about is you're in Melbourne, and well done on riding out such a difficult period. As a Melbourne-based manager, how do you find opportunities in global SMIDs? Because I guess, to see and touch and feel the products, unlike Microsoft and Google, it must be quite difficult. So what's your process to find these companies?
Yeah, it's a good question, and first and foremost, you need to wear out the shoe leather and do lots of travel. So in a pre-COVID environment, we've been doing a lot of travel. We do about 500 research meetings a year. And I'd say about 70% of those engagements, those 500 engagements, would be with small mid-cap companies. So we've built up a pretty deep and rich library of views and theses on these companies. But within that, we've got a pretty well-defined process. So, for example, we screen for companies that have to have a return on equity above 15% for 3 consecutive years. We judge them based on things like management strength, franchise strength, their profitability, balance sheet strength, ESG, and business drivers. And we ultimately end up with a refined list of about 150 companies that we've built up over 10, 15 years. And that list doesn't change very much. So it's a lot of work, it's a lot of fundamental research. And in a post-COVID world, thankfully, our engagements haven't skipped a beat. We're just doing like what we're doing now. We're interviewing and meeting with companies over Zoom. So that's been a pleasant surprise, actually. But at the end of the day, it's fundamental research. We're fundamental bottom-up managers, and you do need to spend time with the companies, particularly in the small mid-cap space, where understanding the management and how they're going to allocate capital is really, really important. I would say that it'd be quite hard to pick up this asset class now in this environment where you cannot travel. So if you didn't have much history with the companies, it is harder to learn companies on the hop in this type of environment, because often they are at their worst, and that's where you can frankly probably make some mistakes.
Okay, and so within the within the context of SMIDs, what are some of the themes that are exciting you the most? 2 to 3 themes that you really like in that pocket of the market?
Yeah, so I think at the moment, given the very unique backdrop we're going through, probably two of the most interesting things I would point out would be that, first of all, in terms of the US consumer exposure in a post-COVID environment, where we've actually seen, maybe not that surprisingly, but some of our companies have done really well. Like they've done incredibly well by virtue of the fact that consumer behavior in the US has changed a lot, because people, they're not traveling, they're not going out for dinner, they're staying at home, and their home has become where they live, where they work, where they holiday. And so you get companies like Pool Corp, which is the biggest pool services company in the US, doing incredibly well because the new holiday destination is the backyard. Companies like Tektronix, which is big in the power drill market. Tractor Supply, which is a really unique retailer. It's a little bit like a regional mini Bunnings type retail concept. And then Yeti, who are the makers of drinkware and coolers and that sort of thing. So they're benefiting from the idea that the way in America, the way people are holidaying, they're camping, they're going on fishing trips, and so they're buying all this Yeti gear. So those companies, it's quite counterintuitive because the economy's been shut down to a large degree from a consumer perspective, yet these companies are recording record earnings, which is fantastic. So that's the one thing. First thing would be sort of the US retail thematic. The second one would be in the healthcare space. We actually find most of our growth stocks in small mid cap in healthcare. So unlike what you see in large cap, where most of the big healthcare names are regarded as being quite defensive and probably a bit more value, we've got companies like Ambu, Align Technology, which make the clear aligners, Straumann, IDEX Labs. They're all going to grow. They're all growing their earnings at 13% plus per annum. So it's a different pocket of growth that we think is quite interesting, and to some degree underappreciated and definitely underrepresented in portfolios.
That's fantastic. And I guess, you talked about there before when you were discussing your investment process that you had to know these companies. It would be really hard to be a manager now, I guess, but through COVID, is anything changed for you as a manager as far as analyzing these companies go? Is there any, change in the investment process or how you need to monitor these companies?
I wouldn't say there's a change in the investment process. It's more the change in how we engage with them is really the main thing. So for example, the conferences that we would typically attend in person have all become virtual. So they're still there, but also I think the benefit of COVID, which was a bit of a surprise to all of us, was that the companies themselves, particularly in small mid cap, because they're not traveling from conference to conference, they actually have more time available to spend with us in this type of environment. So we can do calls and video conference calls with management teams almost at a moment's notice, which is terrific. And to a large degree, I would suggest it probably levels the playing field between, as you quite rightly pointed out, we're based in Melbourne, so we're about as far away from a lot of these companies as you could possibly be. But a lot of other managers, whether they're in Europe or the US, they're in exactly the same boat. So it hasn't really changed the way, had a materially big impact on the way we think about the companies. I'd say that, like I mentioned earlier, having the background and the history on the companies is a huge benefit. Learning companies from scratch now, being so far away and not seeing them in person, is quite problematic, especially given the change in the backdrop and just the sheer level of uncertainty.
You started the business well in time then.
Exactly.
So I want to touch on valuations. So in the context of global equity valuations, the S&P 500, what are valuations in the SMID part of the market looking like?
Yeah, so it's a good question. And this is where we're seeing one of the biggest opportunities in small mid cap is the fact that the forward-looking PE of small mid cap is on trading at about 22 times earnings. And that's depressed earnings this year. So that's not that far up. So that's about a 10% premium to the market, which is in line with the 5-year average. So you've not seen this huge multiple expansion in SMIDs like you have, for example, in large cap growth. So large cap growth stocks are trading on a forward P of about 30 times earnings, which is about a 45% premium to the market. And it's probably the biggest premium to the market they've been in 10 years, which is no huge surprise. So we do feel like there's a pretty compelling relative valuation argument with SMIDs. And then more recently, they have lagged. I mean, in the last 12 months, SMIDs have lagged by probably about 6.5% to the end of September, and about 4.4% per annum in the last 3 years. And that's where, now that lag has not been a function of poor fundamentals. They just haven't kept up with this very narrow universe of massive companies. But what we do think is that there's a likely scenario looking out over the next 2 years where that performance will mean revert. You'll see very strong outperformance in small mid caps. And what we've actually done is we've looked back historically through 2 previous earnings troughs, the 2 biggest earnings troughs in the last 20 years being post the dot-com boom and post the GFC. And what we saw in the subsequent 5 years was that small mid caps outperformed massively in the next 5 years. They outperformed the MSCI World Index, but also large cap growth. And that's a function of really 2 things, but one being just the sheer earnings leverage once you get through the other side of whatever the disruptive event is, but also a PE re-rating. And we feel like now we're in the third of these earnings troughs. And then if we look out into probably the second half of next year, early next year, that earnings leverage in SMIDs will pick up quite a bit, and we will get this mean reversion. And there's a really terrific opportunity to make really strong money in the small mid cap sector.
Okay, then that sounds really exciting. So why don't we finish off with your 2 best opportunities? Give me your best large cap or mega cap opportunity, and your favorite global small to mid cap stock right now.
Sure. So in the large cap space, it's actually Alphabet. So Alphabet, we still feel like we were talking about earlier, it's one of these well-priced, very high-quality companies. So it trades on it's a forward P of about 26 times. It's a pretty modest premium to the market. So it trades on a 7% premium versus a 28% premium on average the last 5 years, but it's growing its earnings by 16%, very profitable, return on capital about 17%, a net cash position of about $105 billion, which is about 10% of market cap. So again, when we look out, we still see in the vicinity of 40% upside in Alphabet. Now, given we're at near the top of the market, 40% upside in anything tends to stick out. So I think Alphabet's probably the main one there. And then in the small mid cap space, it's Yeti. So Yeti we think is a really interesting growing lifestyle brand in the US. We think it's got the potential to be the next Lululemon. It's very much in its infancy. It's only got 4% penetration, 4% of its sales outside of the US. It was founded by 2 brothers in Texas, big in the hunting, fishing types of community, but really growing, becoming one of these real cult brands. And you look at that company, it's a $4 billion market cap. We think it will grow its earnings by 15 to 20%. And again, it's already very profitable. It already generates a high return on capital. And then really importantly, they're being very diligent about how they grow. They're not trying to grow too quickly, which is important. They've got some new distribution partners through Lowe's in the US, which is really just starting to kick in. And again, the other beneficiary they've got from COVID is that their online sales through their website has become a very large part of their overall distribution network. And with that comes terrific margin. So that's a really interesting brand we think is very much in its infancy.
Those sound like really exciting bets, Ned. Well done on your research. And thank you so much for your time, for talking to me today about everything global equities and especially the opportunity in global small to mid caps. I'm sure investors learned a lot. Thanks for your time today.
Terrific. Thanks for having me.